Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. Today I want to take a look at one of the questions that I get very frequently, and one of my favorite questions to answer is, what is a trap? Now, aside from that being an incredibly loaded question, a trap is a lot of things, but the primary requirements for a trap to be, well, a trap, is that it must not have met the minimum target objective of the smallest scale traders, which would be, in this case, scalpers. So let me repeat that one more time. A trap is something that has not met the minimum target objective of the smallest scale traders, which is usually scalpers. If they couldn't even get a scalper's target, then everyone's stuck, right? It doesn't matter who they are, they're stuck. Now, it could just be, traders loading up on the other side of things. Context plays a big role in this. But generally, if they haven't even made it to a scalper's objective, they're stuck. And if they're stuck in a trade and they're looking to do, well, what? They're looking to get out as quickly as possible. Their job now that they've realized that they are completely wrong is to minimize as much risk before they end up in the juicer and get squeezed. So the first thing that really sparks my attention is seeing a scalper's entry on any setup, doesn't really matter, which doesn't reach its target objective. When that happens, my eyes are all ears. Well, whatever, you know what I mean. So let's take a look at some examples of some different traps so we can really kind of go forward in this mentality. So let's take a look over here on the S&P 15-minute chart. And as an example, we've got this incredibly strong bear move to the downside. And, we don't have the benefit of hindsight at the time. So when the market is looking like this, it's looking fairly reasonable to assume that the sellers are going to continue another leg to the downside. It kind of fits the bill. You can see what sellers are looking to try to do. And, well, they fail and rotate all the way back up. After that big rotation all the way higher, you'll notice that there's a little bit of messing around here. And if we throw some market structure on there, we can see where a lot of that bouncing is coming off of. We're getting it off of these L5s. So let's take the perspective of a trader who wants to jump into the short side here, and they're looking for an L5 retest now that we've had some confirmation. Right, we're taking a higher probability stance because we're coming in later to the party. Now, it did make a new high, but again, we don't have the benefit of hindsight. If I were just blind selling right here, where would my stop have to go? Well, my stop would either have to go above the L5 or above the highs. That's about all we have left to work with. Now, again, the assumption here is that the trend is still intact. We haven't broken a major swing high. In the short term, it looks like it's getting going. But realistically, a lot of traders are still going to be looking to the downside. So again, we're not necessarily looking at a swing trade. I would believe that this would be a swing trade. It would make a lot more sense for this to be a swing trade because I don't think the probability makes any sense to take a scalp off of an L5. But remember, we're hunting for traps. We're hunting for the traders who took a really bad setup. That's what a trap is. So this wouldn't make any sense whatsoever to be a scalper. Let's see if the scalpers get their targets. It rolls up, it rolls up, it rolls up. They couldn't get anything done. And when it starts rolling back and beginning to go back to the upside, that is what I'm looking for in the sense of a trap. Where if the sellers are going to be trying to get into this move and get this thing to drive back to the downside, they just totally and utterly failed. And even if they entered in on the top side of this and moved their stops up, right? Let's say maybe they weren't as aggressive. Maybe they didn't want to enter directly on top of the L5. They took this point instead, the upper portion. Now, again, this is all theoretical, but we're just trying to figure out where these traders are trying to get in and where they might be trying to get out. And this is an even cleaner example of how those traps can really play in, especially when they're immediately wrong. Because when you have this initial burst into a trade, everybody likes being right when they first get into a trade. You hit the entry and boom, it just jumps straight to your target. Obviously, everybody loves that. But unfortunately, that just can't be the case sometimes. And as far as a scalper is concerned, if this rifle's right above their entry point, notice right there, they actually hit the upper bound and miss the scalper's objective by just a little bit. So when it went screaming back above, a lot of sellers are thinking, oh no, I messed up. I might have to modify this a little bit and try to get out at a different objective. And you can use actual risk targets, and you can see that that's actually where the bottom was of that move. Go figure. But these are the types of things that you're looking for as far as sellers not making their objectives. Buyers not making their objectives. They're missing what they're trying to do. And when they miss, that's usually when you get that squeeze to the other side that just keeps going and going and going and going. Now, it's even better, and this is where you can really get things to be interesting, is if you can get a trap against a prevailing trend. So as an example, here on the S&P at the moment is a very nice bullish trend to the upside. So if we could find a bear trap where the sellers try coming in, I don't know, like right here underneath the lows of the channel, where they try to sell for a breakdown. And what happens? They try to rotate down once, they try to rotate down twice, they fail and roll back up. Very unlikely that scalpers even have gotten anything if they were selling underneath some of these bear bars even. Like this little inside bear bar right there, if they were locating a stop, I mean, I guess above the top, they might have gotten it from there. They even missed it there. It's even better. So another really good example of how a target has been missed. The scalpers have missed it, and when it screams back against them, this is the follow-through that you expect. They realize, oh no, scalpers aren't looking to sit in this forever. They're looking for that minimum target objective, which is supposed to be high probability. So when it gets close, and then starts jerking away and starting to pull back and closing above their entry point and going further, there's some problems. And that means that if you're looking to go back with the overall prevailing trend, like, I don't know, with this massive gargantuan uptrend, what better stop than a bear squeeze of the shorts who are stuck? That's where you can really start getting the context in sort of the wind in your sail, if you will. But that's going to do it for this one. Hopefully you found it useful, interesting, and maybe something you can add to your tool belt if you haven't really kind of looked at traps or what they are, or maybe you were just looking for a pure definition of what a trap is. But if you have any questions or any examples that you'd like me to take a look at, feel free to drop them in the comments below. If you have a longer question that needs some extended answering, you can always shoot me an email as well, jhb@ssftg.com. Until the next one, we'll see y'all then. Thanks.